What's going on, everybody? Michael Silva here. Buckle up, ladies and gentlemen. The signal is back.
It's Brittany, bitch. And I am back.
It was there at the October bottom. It was there at March 15th. And it is there once again right now. That's what we're going to be discussing on today's Stock Market Brief Show. And obviously lots of other goodies. So let's go ahead and get right into it. All right, people, we're going to take a look at a market snapshot here, a bunch of different products over here, and we're looking at week to date, month to date, year to date. I just want to reiterate this once again. If you're new here, well, you'll probably hear me talk about it more frequently, but if you've been watching the show, you know that I've been talking about the 10-year yield right there and the dollar, and you can see as far as week to date goes, the 10 year's up, the dollar's up, we have Bitcoin that's up too right there, but when you got these moving hand in hand together, we have seen problems in the overall market where the SPY is down, right? Qs are down, IWM's down, everything's basically down. And what I did find interesting today that I want to call out, we talked about yesterday how the IWM went into negative territory year to date. It's down 1.85%. Okay, it's down 3% on the week. It was down 1.68% just today, so some big volatility today. But if you look down the list over here at RSP, this is now negative 2% on a year-to-date basis. You might be wondering, what's that? That is actually the S&P 500 equal weight. Now, we know that the SPY, or the S&P 500, is a cap-weighted index, but when we equal everything out so it all, is equal, what you'll notice here is that we are negative on the year, which basically means that we're being held up by the larger market cap names, the Magnificent Seven or whatever people are terming them. But you can see here, just Qs are still up 33% year to date. So when these big mega cap stocks drop, it puts pressure on the markets, which we've been seeing. And what can put pressure on those big mega cap stocks is the dollar going up, right? And yields going up, right? When yields go up, heavy deaded names or growthy names carry a lot of data. It becomes more expensive, and that could be one of the reasons why we see them, potentially fall or consolidate and so forth. And if you look at the 10-year yield, this thing just hit another new 2023 high, closing in at 4.8%, not too far off from the 5% marker. And I'm really starting to notice here how, we broke out, right? And we're seeing this explosive move. But if you look back to here, I want to just draw this little channel out over here. Boom, this channel, you can see, let me redraw that. I'm going to connect these lines. Yeah, okay. There we go. You can see we're kind of coming out and breaking out of that channel right specifically there. And what I'm noticing is this kind of parabolic type move taking place. And these type of trends, they do not last. We do have an RSI that's getting pretty frothy over here. And we've looked at some bigger charts to be aware of where we can find some potential resistance. I'm not going to touch too much on that today. I wanted to just pop in and look at the 10-year 2-year curve and the 10-year 3-month. And what I'm noticing here is we are seeing them trying to uninvert, still well in inverted territory at 34 basis points inverted and 81 basis points. But this right here is putting pressure obviously on the markets. And you can really visually see that here by looking at the S&P 500 below us, the yield curve above us, and when we got inverted, right, when we inverted going down, right, what you'll notice here is when we're sub-zero, right, S&P 500 was rallying, and then the yield curve inverts more, the S&P 500 rallied, it inverted more, we've rallied, we inverted back down, we rallied big. And what you're seeing here is, well, we're starting to uninvert, and this is where problems have taken place in the S&P 500. And you can even scope out even further to looking at a monthly chart, and you can look at these inversions of the 10-year, 2-year going back to the financial, right, pre-financial crisis and the dot-com bust, and even right over here was right leading into the 2020 pandemic crash there too as well. But what you'll notice here is when they uninvert, all right, when they uninvert is where you typically see things take place in the markets, and we'll see what happens. I know there was some news around Yellen saying, we might not hold rates here. It's not a given or whatever the case is, but it seems like there is something big taking place in these markets, and you just got to be very, very careful in this environment. As it stands right now over here, this is the Fed funds rate, and you'll notice that during the hiking cycle, when we started, pushing back down, right, we're making money cheaper, you can see we inverted, uninverted, pulled rates down. That's where we kind of saw all the, mayhem happen in the dot-com bust. Same thing here in the great financial crisis where they slashed them back down. This is where we saw a lot of the market turbulence and then the yield curve uninverted there. And as you can see, we're still well inverted and we're apparently holding rates higher for longer as the Fed is still trying to fight inflation. That other pesky intermarket asset that we've been paying close attention to is the dollar, and the dollar was up again today. Just been up this, pretty parabolic type rise. I mean, it's not like, breaking way throughout these highs over here, but this is a pretty straight shot going, I believe, 13 weeks or so in a row, green candles, which is very rare to take place. I think that the last time, if I remember correctly, was like in 2014. It went for the same amount of time. Okay, I'd have to double check that, but I'm pretty sure. I had a chart in front of me earlier today and I was looking at that. But yeah, so it doesn't matter really, honestly. It could keep going, right? That's how these type of things work. If actually I were to zoom out into a bigger time frame, we broke out of this, and I mean, it looks like it could be a clear shot to 110 or that upper Bollinger Band as it's pulling down. And you can see where prior support held up, we broke through, and now it held it as resistance. We have the price percent oscillators trying to curl up here too. So at some point, it's going to have to take a little bit of reprieve, a little bit of a break. RSI is getting pretty frothy. We have a shooting star type candle as we've been blowing off here. The market has been coming in. A couple other big charts too to just be aware of, despite even if the market signals that we potentially could bounce here. This is starting to break down on the monthly chart on the New York Stock Exchange Composite Index. And that's, it's been holding for quite some time. This big wedge dating back to, 2007, this trend line, right? We had a high, and then we kind of just pressed these highs over here. And you can see we had the pandemic low connecting with the October low. And then up and through, we started breaking down. And then also the BKX, which is the banking index. This is another big one starting to break down. This is a monthly chart, right? And it's still really early in the month, so things can reverse. But it's down 4.47% as we're heading into earnings season for the financials. And speaking of financials, if I'm looking at the quarterly chart, one of these that I shared with you at the beginning of this month, this is a shooting star type candle on the quarterly, and you can see we had some pretty wide body candles, authoritative, but it was kind of just flagging up. Then we had this indecision type candle closing at the low, and we started breaking the low already here. So if this doesn't quickly recover, could spell out bad news where we go retest these lows on XLF, which could be, obviously pretty bad for the market because these are big market cap names there in the S&P 100 and 500. If we take a look at Russell 2000, we also cracked down through the quarterly low from the prior quarter. That was quick, right? And we're below the quarterly 5 EMA as it's starting to decline. We closed beneath it the last quarter, and we're kind of following through there. So if you want to be bullish, we need to be back above 176.64 for these small caps. Junk also broke the low of the last quarter. Okay, so that was very quick action there. As you can see, authoritative candles, then a small body, right? And now we're breaking that low. So if this doesn't recover, we could start to see volatility pick up again, just based off of, one of the principles of technical analysis. Expansion leads to contraction. Contraction leads to expansion. HYG, it's very similar to JNK, right? This is high yield versus junk there, which I just previously showed, but authoritative candles, right? The bodies got smaller, and now we're starting to break the lows of the prior quarter. All right, so I want to get into the S&P 500 as we've already labeled off. There's obviously, even if we get a bounce, there are some bad things kind of underneath the surface taking place that really you have to kind of let your foot off the gas a little bit here, because obviously there's a lot of risk building both from a macro standpoint, from this technical standpoint that we're going through, from an intermarket standpoint, from multiple standpoints. If we look at the S&P 500 now, we talked about the signal, right, that came about. What signal is this and what's it in confluence with? I'm talking about the Fear and Greed Index. The Fear and Greed Index has been down here at extreme fear, which is right below this level. And this took place on the dates that I mentioned right here at about October 12th and March 15th. And this is typically where, right, and I believe I made even a video here on this date using this same thing. And then I also use it when it goes into extreme greed, which was up above 75 over here. And, I just want to remind you, if you go back and just look at the comments, like over in these areas when I'm talking about it, people are like, no, it's a new bull market, everything's totally fine, blah, 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 blah. But yet, guess what? When it happened, we started selling off. There was a bearish engulfing candle. We had RSI divergences. A lot of bearish ideals started piling up on the surface. And the same thing now, we have some bearish things taking place, obviously, but there's a lot of bullish ideals building up underneath the surface as well, or on the surface or whatever, okay? So yes, we are in extreme greed. You're looking at the fear and greed index. If you want to know more about that, you can go to CNN's website to learn about it. There's a lot of different factors involved, and it's all factors that I pay close attention to, and this just kind of compiles it all together, which is very nice. Now, if I take a look at SPX on the daily time frame, what confluence am I talking about? I'm talking about the lower weekly expected move. We're right there right now, okay? So this isn't really the area where I'd be like, okay, now I want to short, okay? Can you get lucky and it breaks down further? Absolutely. But after a strong move down and you ask yourself, okay, well, if I short here, where am I playing to, right? Maybe you're playing to 4,000, right? Or 4,100, right? Into this area of all this, prior price action. But then what if it just bounces back up to 43.68 and you have to hold on to it and, potentially it gets down there? Maybe, but your capital will be trapped for quite some time. Okay, we're in confluence with the lower weekly expected move, right? So what the market priced in as far as risk. We're right here in confluence with the prior areas of resistance, and resistance can become potential support. We're in an advancing or an inclining 200-day moving average too. Okay, but that's not it. There's actually something hidden here at around 4,200, and that's this big old gamma exposure level that came in today that could act as a potential level of support as well. Okay, so I'm looking at that. If I'm taking a look here, if I draw out these gamma exposure levels and just show you what they look like on the chart, you can download this chart. I'll have a link in the pinned comment for the chart deck, and then also for my partners, my partner in Interactive Brokers, and then also my Patreon group there too as well. Okay, and you get to look at all these different specific levels. So if we get under 4150, that's would be obviously more dangerous, but we're not. We're pretty far off of that as it stands this current moment. Unless something really just dramatically breaks and we get this massive gap down. But 4,200 gamma exposure level is in confluence with the 200-day moving average that's advancing. We're in an area where we saw prior resistance, and that could become support, and we're at the lower weekly expected move. And on top of that, we're obviously at a extreme greed level here, which we've seen prior, right? Seen prior on the S&P 500. And once again, what I find very interesting about where we're coming in as far as its extreme greed goes and where it matches up on these levels, I want you to pay attention here. Take a look here at the channel that I drew out. That was right here towards the lower right end of the channel, and it was right here at the lower channel. And now we're starting to break down from the channel. So what happens here is if we start bouncing back up, everyone's going to be calling this right here a bear trap, right? People get freaked out, it goes down, right? But no one's paying attention to all these levels of confluence. They start shorting into it because it broke, and then all of a sudden we get our face ripped back up to the upside. And even if it's a face ripper right up here, yeah, that can still get faded, and we can eventually move down further. That's more than possible, but you just got to be aware, hey, is this where I should be shorting? This is where I should be covering? Or should I be trying to play tactically long? Okay, so that's kind of what I'm looking at. If I look at SPY, there's another level of confluence, and that is the year-to-date anchored volume weighted average price, the anchored VWAP. Okay, so you can see price is pulling down in there. That's in confluence with the 200-day moving average and the lower weekly. So we just have all this confluence building up while there's a lot of fear kind of, surfacing and presenting itself. So this could present itself as a good opportunity to potentially look at maybe some names if you're a longer-term investor, things that have gotten beaten down, and you're like, hey, I just want to, have some more exposure. Or if you're a tactical trader, I'm more of a tactical type trader. You can look for intraday bounces and so forth. When you look at the 15-minute time frame, you can see we're right down there by that lower weekly expected move. The 5-day moving average, it's still declining. So if you really want to be patient, wait for price to get back above it and wait for it to start inclining. Other than that, you can look for potential, bounces back up into it, maybe perhaps to 425, which is the upper daily expected move, or even the 2 standard deviation move right at around 428. Today's move alone was a 2 standard deviation move. It actually got caught up right here. This was where approximately the 2 standard deviation move was. If you don't know what these these levels are exactly. That's okay. Think of it in terms as a distribution curve, right? 68% of the time, one standard deviation closes within these expected ranges, and these expected ranges are based off of implied volatility, which is future looking. It's what the options market is pricing in as far as risk goes. Okay. Went over a lot today, but there are, like I said, a lot of signals, a lot of confluence building up for that potential bounce. We had this little rip down to the downside that could potentially be a bear trap, but yet the trend still remains down. We have things like the banking index breaking down the BKX, the New York Stock Exchange. We have the 10-year yield still ripping. So once again, you got to be patient here. You got to be tactical and just be aware of these key levels. That's all I got for you. See you later.